Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we're diving into the essential steps you need to take before handing over your money to any private credit fund. From audits to track records, here's how you can invest with your eyes wide open. How missing data hides bad loans and defaults. One of the most common tricks in private credit is a practice called amend and extend. When a company cannot pay its debt, a fund manager might simply change the rules of the loan. They might lower the interest rate or push the due date back by 5 years. On the surface, the loan still looks like it is performing because it isn't technically in default. However, the borrower is actually failing, and the manager is just hiding the truth to keep fees coming in. Without open books, you will never know a loan is failing until the money is already gone. This lack of honesty creates a zombie portfolio where many companies are barely alive. You think you are earning a high return, but you are actually holding a bag of bad debt. Transparent funds will label these as non-performing or at-risk assets in their reports. In contrast, secretive funds bury these details in complex legal language or skip them entirely. If you don't see a clear list of late payments or restructured deals, you should be very worried. It's your right to know if the manager is propping up losers with your capital. Transparency feature. What it protects you from. Why it matters. Loan-by-loan reporting. Hidden individual defaults. You see exactly who owes you money. Detailed risk ratings. Overvalued, zombie, loans. You know the real health of the borrowers. Sector weighting. Industry-wide crashes. You avoid having all your eggs in one basket. Seeing the raw data helps you spot these red flags before they turn into permanent losses. High fees and conflict of interest in the shadows. Secretive fee structures are another way investors lose money in private credit. When a fund is not transparent, the managers often hide extra costs that eat up your profits. You might see a management fee, but there could be hidden, service, or transaction fees tucked away. These costs add up quickly and can turn a good return into a mediocre one. Because there is no sunlight on the books, the managers have more room to pad their own pockets. They might even prioritize their own earnings over the safety of your principal investment. Think of a non-transparent fund like a black box sitting on a table. You put your money in one side and hope a bigger pile comes out the other. Meanwhile, the person operating the box is taking a cut of every dollar without telling you how much. They might even use your money to bail out other failing projects they manage. This conflict of interest is common when there is no independent oversight or clear reporting. If the manager doesn't have to show you the work, they have no reason to be efficient or fair. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.